Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another velocity banking review. But before we get started, I just kind of want to briefly point out that there are many people addicted to this channel, just watching me do spreadsheets over and over again. In fact, the total watch time of this channel is 59,000 watch hours. 59,000. And this channel is not, I don't think it's even 2 years old. We've made about $5,000 on YouTube revenue. Just me doing a spreadsheet over and over again and doing the same video over and over again about velocity banking. So, if you are new to the channel, go ahead and click the subscribe button so that you can be part of the velocity banking crack addict group because people are addicted to watching these spreadsheets. And by the way, before I even get started, let me briefly look at this mortgage I paid off in 2 years and 9 months. Yeah. Yeah, I did. I did. In fact, when I briefly mention it and people in real life, it's like their brain short circuits and they don't ask me anything like, hey, buddy, hey, friend, guess what? I paid off my mortgage in 2 years and 9 months. And then short circuit, pretend you didn't hear it, and then move on to another subject. That's pretty much my life these days. But yes, I did pay it off in July 2024. Right? So let's go ahead and get started. So, what is velocity banking? All it is a debt payoff strategy where you throw all of your money into debt with the help of something called a line of credit. And as you can see here, I've created some pill emojis. They're supposed to represent the red pill, but they could also represent the velocity banking crack. In fact, I got Meta AI to draw me a picture of velocity banking crack. I think that's how you get them. You get them when you're young, right? They seem to be really excited, and I don't think it's a coincidence that it's blue. Kind of like the blue sky candy from Breaking Bad, but apparently this is a velocity banking crack, and then this is velocity banking Kool-Aid. Interesting. But you can drink this Kool-Aid. I kind of promise you can. All right, so let's go ahead and do start the review. So there's really only two things that you need to do velocity banking. Number one is a budget, and then number two is a line of credit. And you're going to use it as your main operating account. So you see this moo right here, this cow. Well, basically, we use that as a representation of what is your main operating account, aka your moo, right? And so for the average American, they use their checking account as their main operating account, right? Whereas for someone who does velocity banking, they're going to use their line of credit. Okay, line of credit. And so what we're going to do is, even though we have the same income and same expenses, right? Same income, same expenses, we're not going to save money. And this is the part that scares a lot of people. In fact, if you ask the average American what's better, saving $100 or saving zero, they'd be like, well, you should have some money saved, right? And we're not going to do that. In fact, we're going to dump all of our money into debt, right? With the help of something called a line of credit. And in your expense breakdown, you have to list every single debt that you have, right? All the credit cards, loans, mortgage, all of it. And then at the very end, you list your general expenses that you always have to pay for, whether the that are not related to debt, food, gas, insurance, and all that other good stuff. Okay, and so what we're going to assume is we have access to a line of credit. Now, I have over $594,000 in lines of credit, and you might be asking, like, what's a line of credit? Well, all it is a financial tool where you could borrow money, pay it back, and then use it over and over again. So, credit card fits into that category, but we also have personal lines of credit. I got like two 15,000 personal lines of credit. There's business lines of credit. Look at this, $280,000 in a home equity line of credit. And if you take a look here, 280,000. This is my home equity line of credit. Okay. And for me, okay, so for me, uh, that means that I could literally go on a bank's website, click a button, and they'll dump up to $280,000 into my checking account when I need it. But here's the secret to getting all these lines of credit: banks don't lend money to people who need it. They don't lend money to people who need it. I know, like, if you ever heard of this first time, it's like, doesn't make sense, right? But once you understand that secret, then you'll be able to get the lines of credit that you need, right? The lines of credit. It's just you got to get it before you need it. And if you have only $100 left over, it's like, ooh, that's not a good sign, okay? But let's assume we did have a free clear line of credit and we move some debt into it. So how do we know how to move debts into line of credit? Easiest way is using something called a cash flow index. So if you take a look here, okay, cash flow index, right? And then, yeah, you see that there's a lot of information here, but basically, it's just a formula, right? It's just a formula of the balance divided by the loan balance divided by the minimum payment, right? So like this, right? So and then it just produces a number. So let me actually just kind of do the formula for you. So the credit card balance, right? Here's 5,000 divided by 175, and then this one is 30,000 divided by 950, right? 950. And then this one is 31,000 divided by 1007.5. And then this one is 21,000 divided by 386.75, right? And then this one is 40,000 divided by 424.26. This one is 210,000 divided by 954.83. And so think of this as a ranking system. So basically, the lower the number, that's the ones you want to pay off. So especially, it has interpretations, low scores, inefficient debt, pay off as quickly as possible. Because what does this mean? You pay it off, you get more bang for your buck in terms of cash flow. Like, am I going to pay $210,000 of the mortgage to only get $954 back in my cash flow, or 31 grand to get even more than that, right? So basically the debt to payment ratio. That's all it is. And you just use it as a ranking system. So what I'm going to do is move all this debt. So 60, what is it? 66? I don't even know. So 5, 30, 31. And we're going to sum it up. So yeah, 66K, and we'll assume we have access to a $100,000 line of credit. Although we don't need it, we could even just say hit 70,000. And heck, let's make it a little bit sweeter, 10%. Okay, 10%. I have a 7.5% line of credit. You take a look at this one, $280,000. And look, I don't save money. You see this? No money saved. Okay, money comes in and it goes out, and we put it into the line of credit. So guess what happens when we move this debt into the line of credit? Well, all of these credit cards go to zero, right? You see that, how these three credit cards went to zero? And then we magically went from $101 to $2,234.16 of cash flow. Oh my goodness. How do we go from here to here? And as I said before, if you ask like the average American, like, oh my goodness, you don't save money? What's wrong with you? I'm like, yeah, I don't save money, because now it's like a multiplier of 20, almost 20, by not saving, right? Okay. So this is what we're going to do. Final step is we're going to put our entire paycheck into the line of credit, take our expenses out, and then rinse and repeat over and over again. So after every single month, the balance of the line of credit should go down by $2,234, right? So it'll go down by $2,234, and then I'm going to do this, and then this is going to be this minus 2234.16, right? And then what we're going to do is take the average daily balance, right? Average daily balance multiplied by the interest rate, which is 0.1, 10%. And then look at this, $6,000 of interest, but not really, because you got to divide by 12 because it's calculated monthly. And then you just do the same thing over and over again. Paycheck in, expenses out, paycheck in, expenses out, right? Balance of the line of credit is going down. And look how rapidly we're reducing the debt, which is 34 months. See how easy that was? Look at that. Zoom out. This is your history of your line of credit debt being erased. And if you need a little bit more money, then borrow an extra 1,000 here and there. Spend less other months, month 13, 14, 15. You just have to be approximate in your expenses. So some months you might spend a little bit more, and other months you might spend a little bit less. See how that works? And we're in month 34. So 34 months, right? And we paid off 66K of debt. Okay. And this is where we get people addicted, folks, because a lot of people, when you just show them this, okay, I'm gonna go ahead and hide this for now. When you show them, hey, let's say that you have $5,500 of income and you have all this debt and you only have $100 left over in savings. Do you need to make more money to pay off your debt? Everybody's like, yeah, you gotta, because look at that, you're not even saving money and blah 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 blah. And we go from here to here. How do we go from $101 to $2,234.16? That makes absolutely no sense. That makes absolutely no sense. But this is where you get addicted to the velocity banking crack, and you get addicted to what we call these financial red pills, right? So all right, so let's go ahead and tackle on the next debt. So let me just kind of go right here. So in 34 months, so we got this loan calculator right here. And when you put in this current month, you get the current balance. And again, we just use the cash flow index again. So I'm going to pay off this 9 grand to get the $386 of cash flow rather than 30 grand to get the 424. So let's go ahead and move it into the line of credit, and I'm going to go ahead and do this. So we're going to move this here. So this is going to be plus 9616.67. And then, okay, now this cash flow has increased because we paid off the auto loan, and then 2,620 and 91. Okay, 2620.91. All right, so now this is going to be 620.91. Copy and paste, and then now we see that right here, okay? It's 38 months, right? So 38 months we paid off the auto loan. 1, 2, 3, 4, 4 more months. Pretty sweet, right? So now we just do 38 months. So 38 months, and then 66 plus 21, and this is going to be 87K. And then now this is going to be at 38 months, right? So 38, 38. This is going to be 0. And then now let's go ahead and pay off the student loan, right? And the higher the number this is, and the more of a difference there is between the interest rate and the line of credit, um, is really going to make a difference of what you're going to do. And what's really important, okay, is if you see this number too big and this number has a huge difference to the line of credit interest rate, use what we call the chunking method, which is just you just take a piece of the loan and move it into line of credit. And you have to make sure you pay off the debt in the correct order. That's the most important thing. Optimal chunk amount is just pretty much your salary, right? Your income. That's pretty much it. So let's go ahead and move this into line of credit, but it's going to be pretty much the same, especially with a student loan, or not a student loan, a loan that where it's not like over 100. So we will pay a little bit more. I think $300 more if we do it like this rather than doing the chunking method. But you know what? I'll be lazy for now. All right, so now let's go ahead and get an extra $400 in our line of credit. And then now we see that our cash flow is 3 grand. All right, 3 grand is in our cash flow. And then this is going to be our new cash flow, which is 3045.17. And let's see how long it takes to pay that off. 48 months, pretty sweet. How, everybody's freaking about their student loans. In fact, if you just kind of do a Google search, let me just do this. Rant about student loan payments increasing. I'm pretty sure there's tons of people out there uh, who are freaking out about the student loan payments increasing. Why did my student loan payment go up? All right. Millennials are watching student loan payments. What does this say? It's probably because it go up because of the president, right? Or the current administration. So huge spikes. Huge spikes. But how long did it take us to pay it off? Just 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. All right, less than a year, not bad. So you just work 1 year and then you're good, right? All right, so now this is gonna be, I think, we're only 50 months. 50 months. 50 months. No, 48 months. I don't know how to do math. Oh, it's 10 months. Okay, not a year. What am I doing? All right, so now this is going to be 48 months, and then this is going to be 87 equals 87 plus 40, and then this is going to be 127K, right? And then, so now, okay, all right, so now we got to do the mortgage. So at 48 months, all right, so this is our current balance. Now, luckily, we had the velocity banking calculator to help us do all this. And all right, so 185,027.12. So 185,027.12. And then I think I did I did this wrong last time, but it's okay. But as you can see right here, it pays off in 4.2 years. 4.2 years, literally. Literally. Okay. All right. 4.2 years. And then so now, um, one thing I do want to show is what's the difference between replacing the loan and doing small chunks. So you see, we replaced the loan for 4%. Actually, this is going to be 10% now. Okay. So you see that the interest rate does make a difference. 50 grand of interest. But if you do a $6,000 chunk, right, even at a 10%, look at that. 16 grand of interest, 16.9, 4.2 years. Folks, this is why, you don't want to replace all loans with lines of credit, and the interest rate does matter when you do a full replacement, right? Whereas, you do a 30% line of credit, oh, three grand more, right? Like, okay, I could use a 30% credit card, do $6,000 chunks. But if I do a 10%, take a look at this. 10% line of credit replacement. Ooh, I'm paying so much more interest. Okay. So just a rule of thumb, a small chunk is all you need, just somewhere around your income. So I'm just using $6,000, but it doesn't really make that much of a difference. All right, so 4.2 years, and we're just going to go right here, and then this is going to be 48 divided by 12 plus 4.2, and then this is 8.2 years. 2 years, we are debt free. Debt free. All right, debt free at last. Okay, so just to end here, this is just part of my way of attracting people to get addicted to velocity banking. So if you've made it all the way to the end of the video, welcome to the Velocity Banking Crack Addict group, right? You're part of the, let me take a look at the channel analytics. The group of people who have watched 59.5 thousand hours of this, and actually, let me do this 59.5500 divided by 12, and then that's how did I do that right? No. Divided by 24. My bad. So 2,479 days of we should ignore the dollar sign. Let me make this a little bit better. So we'll just do this right here. So this is the number of days watched, and then if I just do 365, 6.79 years. 6.79 years. So keep watching, feed the beast, get addicted to the content, and welcome to the Velocity Banking Crack Addict group. Okay. All right. Well, that's it for today, folks. Korean Atlanta Mentorship, and I'll see you all in the next video.